In this video, I have compiled the 11 most important trading lessons that I wish I had known when I started trading 15 years ago, and I will show you exactly step by step on how to implement them into your trading so that you can use them right away. So I didn't rank the 11 things that we are going to talk about in this video. I didn't rank them in order, but I would be really interested to hear from you. What do you think is the number one, number two, number three most important points that I'm discussing in this video? So let me know in the comments below. And we're starting with developing a strategy plan. And this is really like your business plan as a trader. And in the beginning, what is the most important aspect is that you define your approach to trading as clearly as possible. In the beginning, I know from experience and also working with traders that traders are always jumping around. And this jumping around and always changing things is going to introduce a lot of noise, inconsistencies, and it's also going to make trading really frustrating when you're not really certain about what you should be doing, when there's always uncertainty and there are always doubts in your mind. But sitting down and writing down your entry and your exit rules, what are the timeframes that you're trading, what are the markets that you're trading, when is actually your trading time, write this down, and you can even turn it into a checklist, which is something that I've talked about on length in my podcast and in the videos. I'm a big fan of writing out your entry and exit criteria in a checklist format and putting it next to you in your trading desk. Also, I would say that 99% of traders only focus on the entry part. How do you get into the perfect entry? But they neglect everything else around their trades. And then once they're in a trade, they feel completely lost. But if you spend a few minutes to talk or to think about your stop loss and your take profit approach, it's going to remove a lot of uncertainty from your trading, and it will make you so much more confident in your trading and into how to approach the charts. And if you have done that, you're way more likely to stick to a plan. Once you have written it down and you have gone through this process to actually think about all the different aspects of your trading, you can minimize emotional decision-making mistakes. A lot of traders are jumping around, revenge trading, jumping into and out of trades, jumping around time frames, taking random trades. But if you have done this strategy plan work, you are way more likely to just follow through, and you're going to reduce a lot of problems that come with this emotional decision making. So in my trading, I think I wasted a lot of time in the beginning with demo trading. And I did trade on demo in the beginning, but I didn't use demo in the right way and in the most effective way. So I'm not a big fan of staying on demo for weeks or even months at a time. And I don't think you need to be a profitable trader on demo before you can go live. But there's huge value in demo trading. And one of the biggest things is that you're learning the platform, but you're also learning all the mechanics of trading. So how do you execute a trade? What are the different order types? Super, super important. Look at all the different order types your broker is offering and then see how they actually play out. How does a limit order work? How does a stop order work? What are all the different options that your broker gives you? And this is something that you need to test on demo. What I would recommend, you pull up your demo account and you go through every feature, you go through every menu, you click on every button and you see what happens. Imagine a pilot. When a pilot is taking his first flight, do you think that he's going into the cockpit and just wondering, oh, what's this button about? Let me push this. No, when a pilot is stepping into the cockpit, he has pressed each button 100 times or hundreds of times probably in a flight simulator. And then he knows exactly what to do in specific situations. And this is exactly the same in trading. When you're taking your trading live and when you're trading in a live environment, you should not worry about your trading platform. You should not wonder and ask yourself, where do I actually do this that I want to do? You should know by heart every feature and every button, and you should have done this in your demo trading so that when you are in the live markets, you only focus on your execution and you don't waste mental capital on actually figuring out your platform. Learning technicals next. Maybe learning is not the right approach or the right term here actually. Maybe it's exploring technicals. And what I think would have helped me in my trading significantly in the beginning is by setting aside 6, 12, 24 months where I just explore different approaches and tools and concepts when it comes to analyzing charts. But I know, of course, in the beginning, we all just want to get to making a lot of money and we don't have time to learn the basics. But over the long term, you're going to waste way more time trying to make it work in the beginning, rather than actually giving you those 2 months where you don't put pressure on yourself, but you explore all the opportunities and the possibilities. There are dozens and dozens and dozens of trading approaches, tools, concepts, ways how you can analyze a chart, ways how you can time and execute your trades. And in the beginning, what I would recommend, every 2 months, switch to something new, learn something new, and see how it feels. You have so many options when it comes to tools and concepts that it's super unlikely that when you're finding your first strategy, it's going to be the perfect fit and it's going to be the most comfortable that you will feel with a trading approach. Go through price action, go through fundamentals, try volume analysis, just try out as much as you can and see what fits, what makes sense. And then after a year, after 18 months, you will be very confident in picking something that actually feels good. And I think this will help you in your trading journey significantly over the long term. Make the best and the most optimal decision and choice when it comes to picking the approach that feels perfect to you. Keep a trading journal. Obviously, we are the founders of the Hedgewonk.com trading journal, so we are super big on trading journals, but you can pull up any trading book and you will always find that a trading journal is mentioned. So keeping a trading journal is absolutely a must-do for traders. A trading journal where you record your trade helps you identify your patterns and the mistakes, so patterns in your behaviors. What is the most common mistake that you make and what is costing you the most amount of money? But also a trading journal helps you find your strength. It shows you exactly when you're making the most money and what is working, when your system is working well, and what are the best trades for you. And also a trading journal helps you to improve your accountability. And being more accountable and holding yourself accountable will just increase the level of discipline. No matter which trading book you read or which trading podcast you listen to, a trading journal will always be mentioned as the most important trading tool a trader needs to have. That's why we developed the Hedgewonk Trading Journal. And currently we run a promotion. So for Tradeciety followers and fans, go to hedgewonk.com and when you buy your Hedgewonk Trading Journal, use the discount code Tradeciety to get the biggest possible discount. Developing a routine is especially important if you are not a full-time trader and if you still have a very busy daily life where you have a job, you have a family, you have other obligations. Being very certain when you are marking up your charts, when you're doing your trading plans, when is actually your active trading time, when you are doing your post analysis, all of those things, you need to be very clear on them so that, first of all, everything gets done. If it's not in your calendar and if you're not clear about what you need to do and when you need to do it, very likely you're going to skip important parts and that's going to ruin your consistency. So on the other hand, having a good routine and being very clear about your schedule helps you to improve your consistency. So you update your charts ideally every morning before you start your trading day or the night before if that's an opportunity and if you prefer that. And you also create trading plans. So before you sit down to actually trade, make sure that you identify the best opportunities. What is the best chart for the day or what are the best instruments and what are the best tickers for that day? What I like to do then is I set my trading alerts at important key levels so that I get notified once something important happens. And that way you are way less likely to actually miss good trades. Again, you need to experiment with different trading styles. I mentioned in the beginning when we talked about technicals, but it's also true for different trading styles. Try different time frames, try a swing trading approach, try a day trading approach, and see where you feel comfortable. It's so important that you find something that resonates with you. And the best traders that I've worked with, they eventually find something that just clicks for them. It's not the traders that copy another trader the best that makes the biggest progress, but it's the trader that experiments, that tries a lot of different approaches, a lot of different strategies, and then finds one thing where he's feeling comfortable. And those are the traders that will make the biggest progress. Realistic goals is something that is super important for traders, and it's something that can completely ruin your trading as well. First of all, you need to set yourself achievable targets. So what you should do is you identify where you are currently. Are you a losing trader? Then your next step in your trading journey should be to eliminate big losses, make fewer mistakes, and get to a break-even stage. If you're currently a losing trader, don't plan on how you're gonna make 10 or 20 or 30 million US dollar a year. Make sure that you identify very clearly, very realistically where you are in the current moment and what is the next step and how do you get there. And by focusing on the process, it will help you improve your trade quality. Don't focus on how many trades you need to make, how much reward to risk ratio you need to get out. I know we've all been there. We have all created those Excel spreadsheets where we projected our trading account into the next 5 or 10 years. And we see how long does it take to get to $1 million. I know we've all been there, but it doesn't help. And I wish I had known this sooner, that having realistic expectations is so important, because those unrealistic expectations drive a lot of bad trading behavior. And then over time, as you grow, you obviously adjust your goals. Every 6 months, you see, okay, how much progress have I made? How close am I to my next trading goal that I set? And then you always expand your horizon a little bit. You set slightly larger goals going forward. And that way, over time, over the next 3, 4, 5, 6 years, by every 6 months setting a new, slightly larger goal, you're going to make huge progress over the long term. When you read the famous trading books, traders and the professionals will often say that they don't see themselves as a trader, but more as a risk manager. And this is really an important perspective. You're not here to trade. You are here to manage your risk. And it starts with consistent position sizing. In the beginning, I said it, but it's so important that I cannot stress this enough. You need to be able to size your position. You need to make sure that you are able to achieve a consistent position sizing approach. How much percent of your account are you risking per trade? Be it 0.5, 1%, or 2% per trade, doesn't matter. But you need to be able, just from a pure skill perspective, to know how many units, how many lots, how many stocks, how many contracts you have to buy to achieve a consistent position sizing risk level. And then you also need to be comfortable with taking risks. I see a lot of traders have problems getting into trades, and then when I look deeper and I audit their performance, I see that they're taking way too much risk and they're too scared of losing big amounts of money. And then what I recommend is start small. Instead of risking 1% or 2%, start with 0.25%. The money obviously will not make a difference if you're just winning 0.5% or 0.5% per trade. It's not going to change your life right now, but that's not the goal right now. The goal is to get comfortable taking risks. And as you are able to pull the trigger more and more on those smaller positions, you will get comfortable just being in the market, executing trades, seeing your broker P&L go up and down. And then over time, you can slowly increase your risk. And eventually, you're going to arrive at the risk level that you wish you were a year ago. But this way is much more consistent, and it's also much more sustainable. So I'm a big fan of testing your strategies, and this is typically done through a backtest. The backtest for me is not to verify if my trading strategy is making money necessarily, or how much money I can pull out of the market, but it's about collecting data. For example, how many trades can I expect? I want to test different target approaches. Is a 2-to-1 reward to risk ratio better? A 4-to-1? Is a trailing stop loss better? Should I move my stop loss to break even? Those are all the things that you can collect from a backtest. Also, the likelihood for winning and losing streaks, because that's so helpful when you make the transition to your live trading. Once you see, okay, in my backtest, a 4-loss losing streak happens every 20 trades, then you're prepared for it when it happens in your real trading. Also, backtesting helps you improve your pattern recognition. When in an afternoon, maybe you set aside 2 hours for a backtest, you can go through 6 or 12 months of trading data and historical charts. You're going to see a lot of patterns, and you'll see how they play out. And that's going to help your real-time trading, obviously, as well. Checking the news calendar is so basic, but a lot of traders forget it. In the morning, check when important news are coming up for the markets that you're trading. A lot of traders ask me and share their trades with me and say, why did this spike happen? What did I do wrong? What did I overlook? And then I just ask them, did you check the news calendar? Was there an event? And then they will come back, oh yeah, sorry, my bad. I could have avoided this. I shouldn't have traded this because my rules actually say I should not trade during news. It's so avoidable. It's so simple. It takes a minute in the morning. You just pull up any news calendar and then you see when is the time where news come up, when is the high momentum or high volatility trading period that I probably should be avoiding. And then, of course, learning from mistakes. Again, this is best done through analyzing your trades through a trading journal. So you analyze your losing trades and you identify the cause for your losses and you work on your weaknesses. What is something that I see so often in the Edgewonk reviews that I do on our Edgewonk YouTube channel is that traders believe that their system isn't working. But when you look into the actual losses, it's not actually the trading system that is losing or that's the problem. It's the trader that is making all the mistakes. All the trades, when the trader is following the trading rules, he is making money over the long term. He has a positive expectancy. But all of the other trades in between those good trades where he's deviating from the plan, those are causing his losses. And that's why it looks like his system isn't performing, whereas he should not change the system because the system is actually making money, but the trader is the problem. And you can only do that through analyzing your last trades. And of course, adapting your strategy, constantly adapting, playing around with different ideas. I think that's super fun. I think that's something that I should have done sooner because it's actually quite fun. It's enjoyable to look at your system and you look at your trades and see how can I tweak this? What if I take a little bit of an earlier or later entry? What if I only trade at specific times of the day? What if I use a different stop loss or target approach? And that way you can keep evolving your trading strategy as the market is evolving. You will make new findings about price action, and that will help you grow as a trader. It will also help you keep trading fresh and exciting because trading can easily become very stale when you're doing the same thing day in and day out. But looking for ways to improve, to grow, looking at your data will help you find new ways how you can improve your edge.